Hi guys, today we're going to have a look at monetary policy and everything you need to know about it. So to start off with, monetary policy is how the central bank influences the state of the economy through varying interest rates and money supply. You have to remember that as with fiscal policy, monetary policy has two types, expansionary and contractionary. So expansionary monetary policy would be where the aim is to increase GDP, but the negative part is that inflation would also increase. Whereas with contractionary monetary policy, the aim would be to reduce inflation. And with that also comes reduced GDP. You have to remember that it is also a demand side policy, so it would affect aggregate demand. And aggregate demand is equal to C plus I plus G plus X minus M. So the C is consumption, the I is investment, G is the net government spend, X is the exports, and M is the imports. So this diagram would show you that a shift in aggregate demand would, have a change in inflation or GDP. So if we start off with expansionary monetary policy, like we said, the aim is to increase GDP, but it would also increase inflation. And with that, we know there are two ways, really. So if we're looking at interest rates, well, if we reduced interest rates, that means that the reward for saving your money would be less. For example, a bank will say the interest rate is 5%. So that means every year that your money is in the bank, you get 5% on that. Now, if that was to reduce, you would have less reward for saving, which then means you have less motivation to save in essence. So consumers would save less and they would spend more. By spending more, consumption would increase and therefore aggregate demand would increase and GDP would increase. But like we said, inflation would also increase. We could also look at that change of interest rate from the viewpoint of a company or a firm. If the interest rate grows down, the cost of borrowing would also decrease. That means it's cheaper, in essence, for a company to get a loan, which means not only a company, also an individual. So firms and individuals would then borrow more money in theory because it's cheaper. So that means consumption and investment would increase, which then means aggregate demand would increase, and therefore GDP would increase. But like we said, inflation would also increase. Now, when dealing with expansionary monetary policy, the other side of it was quantitative easing. So, like we said, it's affecting the money supply. So, what the central bank would do is they would increase the money supply. In order to do this, there are several ways to do this, but one of the ways would be that the government would buy back bonds from commercial banks. Now, commercial banks are what regular customers would use or companies would use. And that means if they're buying back bonds, the central bank is in effect paying these commercial banks for these bonds. So the commercial banks then have more money to give out. And if they have more money, a bank would want to invest it. And by investing it, they would give out more loans, or they're more likely to give out loans because they have more capital. Therefore, investment and consumption would increase as it's easier to get loans in essence, which means aggregate demand will increase and GDP will increase. So, like we can see on the diagram, we're moving the aggregate demand curve out. With contractionary monetary policy, like we had first mentioned, the aim is to reduce inflation, but that would also reduce GDP as shown in the diagram. One way to do this would be to increase the interest rate. Now, if the interest rate is increased, that means you are getting more reward for your saving in a bank. So consumers would save more money and they would spend less, which therefore means that consumption would decrease and therefore aggregate demand would decrease, inflation would decrease, so GDP would also decrease. The other alternative would be to look at it from the idea of loans. So the cost of borrowing would increase. It becomes more expensive for you to get out a loan. Therefore, firms and individuals would borrow less money, which would lead to less consumption and investment because loans are more expensive. So therefore, aggregate demand would decrease, inflation would decrease, and GDP would also decrease. And lastly, we're also going to talk about the evaluation. So with the evaluation, you really have to think about how much. So how much are the interest rates going to change, or the money supply? Are they going to be significant changes? Are you going from 1% to 5%, or are you going from 12% to 3%? What are the changes? For example, in the UK, just before COVID, the interest rate was about 0.75%. Now, as COVID hit and they needed to stimulate the economy, they wanted to increase GDP, the central bank decided to lower interest rates. But they could only lower it so much, because then they went to 0.25% eventually. But lowering it by 0.5% was not really significant enough to have a large effect. With that, you can't really have negative interest rates either, because that means that you are basically getting paid to borrow money, in essence. You have to think about time. How often are you going to increase interest rates? Is it going to be every month, or is it going to be, every year, or over what period are you going to increase or decrease these interest rates? You need to think about contracts as well. So with contracts, you have certain contracts in place. For example, if you have bought a house and the interest rate is 5%, you are fixed into that for some time period. So any interest rate changes in that time period are not suddenly going to start affecting you. Which means if the interest rate was to increase in that time period, you are going to carry on spending as you are. Or if it was to decrease, you will carry on spending as you are. You're not suddenly going to change your um, consumption or investment patterns because of an interest rate change. You also have to think about other policy clashes. So like we'd mentioned with fiscal policy, you would have expansionary monetary policy happening. But for example, if the government were to then cut budget, that would be contractionary fiscal policy, which therefore the two policies would clash, and you wouldn't really have the desired effect for the economy. You have to remember that fiscal policy is controlled by the government, whereas monetary policy is controlled by the central bank, or in the UK's case, the Bank of England. So their visions are not always aligned, and that might lead to not the best outcome happening for the policy. And lastly, we have to think about confidence. You have to think about confidence in the market. So, for example, if we were to take America in 2007 and 2008, just before the economic crisis, everyone was really confident that they could pay back loans, which meant interest rates were climbing, but that didn't deter anyone from taking out a loan, or that didn't deter anyone from borrowing money, because everyone was confident that they could borrow it, which goes against kind of the whole idea of monetary policy, in terms of if the interest rate increases, people would borrow less. Or it might be a case like COVID, where the interest rates were really low, but no one had a job and they didn't know how they could pay back loans. So they were not willing to borrow any money. Banks were not willing to loan out any money, because they were just really unsure as to how people would pay back this money. So even if the interest rates dropped, loans were really difficult to get a hold of. So that didn't increase consumption. It didn't increase investment either. So confidence is a big part of this. And like always, please like and subscribe to our channel for more videos as well. Give us a comment below if there's anything that you didn't understand. But remember, this video is everything you need to know about monetary policy, from how to lay out your answer, how to have all the analysis points, but also all the key evaluation points. And that will really help you get the highest grades possible. You have to remember to explain everything in detail, step by step, so that it follows a logical thought process. And yeah, I hope you enjoy the video, and let us know if there's anything else that you want to go over. Thanks for watching, guys.